All right, so we want to look at IFRS 16, which is leases. So you may have seen from your course outline that it sometimes refers to IFRS17 as the standard that you need to do. But it's important that we know that IFRS17 was phased out and replaced by IFRS 16, effective 1 January 2019. So as you are doing your practice and going through your past exam papers, you may come across questions that are going to be talking about IFRS17. So answer this question in accordance to IFRS17. You no need to worry. So I just wanted to highlight a few differences between IFRS17 and IFRS 16, or a few issues about IFRS17 that have been maintained and those that have been changed in IFRS 16. All right, so IFRS17 required us to categorize our leases as either finance lease or operating lease. So we needed to consider whether it's finance or operating. Right, so the standard basically said an operating lease is a lease that is not a finance lease. So its main focus was on determining whether a lease was actually a finance lease or not. If it is not a finance lease, it then automatically becomes an operating lease. And then it set conditions that needed to be satisfied for us to then say a lease is a finance lease. And we are going to discuss just a few of them to put it into perspective and then highlight how it is different from IFRS 16. So the standard required, for instance, that we consider the lease period and compare it with the useful life of the asset. So basically a lease arrangement, we are saying someone owns an asset that I want to use. Perhaps they've got a building that they own in town. I want to use that building for offices. So I go to them and say, I want to rent your buildings. I will be paying you a specific amount of money every month that you would have set yourself. So perhaps I'm renting a building over a period of 3 years, and I'm paying perhaps $1,000 a month over those 3 years. So there is the person who owns the building, that person is the lessor, and there's me who is renting that building and I'm the lessee. So we then look at the arrangement between the lessee and the lessor and say, if the lessee is renting the asset over a substantial part of its useful life, so perhaps the useful life of that particular asset is 5 years, I'm renting it for 4 of the 5 years. It means I'm renting it for substantially the bigger part of its useful life. So in that instance, we'll then consider that lease to be a finance lease. It's as good as I'm being financed to purchase that building, and the amount that I'm paying every month over the next 4 years are the same as if I'm paying off a loan to actually purchase that building. Or the owner has sold the building to me, but I'm actually just paying installments until the end of the 4th year. Secondly, would then consider whether there is a possibility that I would actually take possession of the asset at the end of the lease period. So perhaps we have agreed that at the end of the 4 years, I will then take possession of that particular asset. If I'm going to take possession of the asset at the end of the lease life, it then means it's as good as I own the building, which makes it a finance lease. Or perhaps I'm going to purchase that building for a fee that is significantly lower than the market price. So perhaps after the 4 years, the value of the building is 100,000, but we have agreed in the lease that I will pay 5,000 for it. So it means it's as good as I own the building. So that's the finance lease. Then any lease that did not meet these and other conditions specified in IFRS17 will then ordinarily be an operating lease. So if a lease was then an operating lease, it means whatever payments I will be doing on a monthly basis or quarterly basis or yearly basis would be then considered as expenses through profit and loss. So as in the end, when I incur them, I basically just recognize them as expenses. So that's how we would then treat an operating lease under IFRS17. The treatment of a finance lease It's what we are then going to discuss under IFRS 16. Now, come IFRS 16, we now have just a lease, right? All leases will then be treated the same. And these leases will be treated similar to the way we were treating a finance lease under IFRS 17. Right? There is no operating lease anymore as far as IFRS 16 is concerned. It's saying all leases should be treated the same, which is the same way we're treating finance leases under IFRS 17. But there are two exceptions. So take note that these are exceptions. There is no operating lease anymore, but these are exceptions to the treatment of a lease that is prescribed by IFRS 16. So IFRS 16 says, if you enter into a lease that is a short-term lease, so we're talking about a short-term lease, perhaps the lease is just for 12 months or for 6 months or for 3 months. There is no point in you going through the complicated treatment of a lease that we're going to discuss just for a period of 12 months. So it then says, if it is a lease for a period of less than 12 months, simply recognize the expense through profit and loss. Whatever amount you would have paid as the rentals for the property or as rentals for the asset, just treat them as an expense through profit and loss, which is basically the way we were treating an operating lease. We are simply just not saying operating lease anymore, but the treatment is the same. The second exception is if the amount is trivial or insignificant, right? So the standard leaves this to judgment to say what amount do we consider to be small or insignificant or trivial. So let's take an example. Let's say we have company A and company B. Company A has a balance sheet of 10 billion. Company B is a balance sheet of 10,000. Both of these companies are renting properties where they are paying $1,000 as the rentals. So for a company with a balance sheet of 10 billion, 1,000 could be considered insignificant. So if you are renting a property for 1,000, we would then consider it as an exception under the amount, which means you would then just expense it through profit and loss. But for a company perhaps with a balance sheet of 10,000, 1,000 is significant, which means it then falls outside the exception, which means we are going to just treat it as a normal lease. So that's basically the differences between IFRS 17 and IFRS 16. So the way we are treating a lease now is the way we were treating a finance lease under IFRS 17. So that's what we want to go through now. Now, we are saying basically a lease arrangement is where one party, the lessor, is an asset that the other party, the lessee, wants to use. So they enter into an agreement where the lessee will be using the asset and then pay the lessor, who is the owner of the asset, a certain amount of time over a certain interval. Right. So let's say I am renting a building from you that I want to use for offices. You have a building in town, I want to use it for offices. I'm paying you perhaps $1,000 a month over an agreed period of 3 years. Right. So it means I am renting a specific asset. I'm renting a building, I'm renting a motor vehicle. It means the asset must be specified. That's what we mean when we say an underlying asset. So the contract should have a specific asset in mind. Then, because I am paying you rentals, I have the right to use the building. So it means I am using that building because I've earned the right to use it, because I am using it in exchange for a consideration. So it means I have an underlying asset, which is a building, and I am using it because I've paid a consideration, which is $1,000 per month. That consideration I have paid gives me the right to use the building. So that's basically what a lease is. Now, this is how we treat a lease. So we have said I have the right to use the asset because I am actually paying a consideration for it. So since I am paying a consideration for it, and I have the right to use it over a specific period of time, which is more than 1 year, because we said if it is less than 1 year, it means it's an exception because the period is long. So if I am going to use this for 4 years, it means I am going to then recognize an asset, which is right of use asset, and consider that the useful life of the asset is 4 years. So the idea is, let's say the useful life of this asset is 5 years, and I'm going to be using this asset for the next 4 years. What I could have simply done is go to the bank, borrow some money, buy this building from you, and then the building becomes mine. And then I'm paying installments to the bank on a monthly basis, right? But what I have done is I've agreed perhaps similar terms with you, where I'm paying you rental payments instead of paying loan installments, which could have been the same amounts I would have paid the bank if I had gone to borrow money and then come and buy the asset from you. So we are basically then treating this the same way that we would ordinarily treat a purchase of an asset, right? So I have the right to use an asset. So I'm going to then recognize an asset in my statement of financial position, and then use the lease period of 4 years as the useful life of the asset. Right. Then over and above that, if I'm recognizing this asset to say it's as good as it's mine, because perhaps in 4 years' time, the building will then be transferred to me. It means I need to then recognize the fact that I am recognizing the asset today, but I've got an obligation to pay rental payments over the next 4 years, which means I have got a liability related to the lease. So this is called lease liability. All right, so I'm going to recognize a right of use asset. This is going to go under my non-current assets. I'm also going to recognize a lease liability that is going to go under non-current liability. So basically, let's say for argument's sake, if I had considered buying that assets today, I would have been charged 10,000 by the owner of the building. So now, because I'm not paying all of it today, I'm paying in monthly installments over the next 4 years. It means it's as good as I have taken a loan for 10,000, purchased the building, and then I'm paying back the loan over the next 4 years. So we are then basically saying we are recognizing this asset at $10,000, but we are not going to say buildings, because literally you don't own the building yet. But what you have is the right to use that building over the next 4 years. So in our statement of financial position under non-current assets, we are going to recognize an asset. We are going to call it right of use asset. All right. Then we are then going to depreciate that asset the same way we would have depreciated it if we actually owned it. So if the lease period is 4 years, we are going to just depreciate this asset over a period of 4 years, which means our depreciation every year for the next 4 years is basically 10,000 divided by 4. You may then get scenarios where the useful life of the asset is 5 years, but the lease period is 4 years. In that situation, you always consider the lease period as the useful life for the purposes of calculating depreciation. It's not logical to get a scenario where the useful life of the asset is 5 years, but you are renting it for a period of 7 years, because it means the other 2 years you will actually be using an asset that is now useless. So our expectation is the lease period will be either equivalent to the useful life of the asset or less than the useful life of the asset, in which case we use the lease period for depreciation purposes. So we have a right of use asset. The value is 10,000. We are depreciating it over 4 years. Then the right of use asset, we remove it once it is fully depreciated. Then we are going to then recognize, so this is the asset. So this is the non-current asset that we call right of use asset. Then we also have the current liability portion, because remember, you've not actually paid this 10,000. You're going to pay it over the next 4 years, which means this is actually money that you owe, which means you need to go and recognize the liability to show that, yes, you have recognized the right of use asset, but you don't own the asset yet. So we are going to recognize a liability of 10,000. Now, the expectation is, if you had gone to the bank and borrowed 10,000 and you are then returning the money to the bank, you are not going to give the bank 10,000. Obviously, they are going to be charging you interest, which means your obligation is going to grow each year with the amount of interest that you would have been charged by the bank. Our expectation is the same. If the owner of the business feels that the asset is worth 10,000 and you are paying installments over the next 4 years, there is no way that is going to then say 10,000 divided by 4 and then determine the amount you need to pay per year, because obviously if you had given him the 10,000 today, you would have spent it to buy more things than the 10,000 will buy if you are giving him the money in installments. And so in all cases that you are going to come across lease questions, you are going to be given an interest rate. So the interest rate is for you to determine the interest component within the transaction. You are going to do a question that is going to illustrate that. So that's one is called the borrowing rate or the interest rate implicit in the lease. Right. So the 10,000 here is a hypothetical figure, but we want to then look at what it is that we put or the figures that we need to consider when we are determining the value of the non-current asset, which is the right of use asset, and the value of the non-current liability, which is the lease liability. Okay, so we are saying at the inception of the lease, this is what we will need to recognize from a lease liability perspective and from a right of use asset perspective. So let's start with the right of use asset. What amount are we going to put under non-current asset in our statement of financial position? So we recognize it cost, which is equal to the initial value of the lease liability. So let's say you have determined that the present value, or if you were going to buy the building today, how much would the owner ask for? Perhaps the owner will ask for 10,000. That is the initial value. Then, what are the payments that you have made at or before commencement? So let's say, for example, the owner of the property said, I want you to pay a deposit of 1,000 now before you enter into the building. So that 1,000 you have paid is part of the right of use asset. So we are going to add it to the 10,000 that we said was the fair value or the amount that the owner of the building would have asked for if he had actually bought that building on that particular day. Then, are there any initial direct costs that you have incurred, maybe legal fees in making sure that the contract goes ahead? So maybe you have paid direct legal costs of 1,000 to ensure that you actually enter into that lease. Then perhaps the nature of your business is such that you need to put some fittings within that particular building. And when the time comes that you need to move out of the building, you are then required to dismantle those fixtures. How much will it actually cost you to do that? So what is the estimated cost of the asset removal or dismantling as per the lease condition? So if you had said, we are going to incur 3,000 to then put the building into the state at which you found it when you entered the lease, we are then going to then say your right of use asset is 10 plus 1 plus 1 plus 3, which gives us 15,000. So this is the amount that you then depreciate. Right. Let's go to lease liability. So lease liability, you recognize at present value of payments not yet made. So liability basically by nature means an amount that you owe, that you are going to pay at some point in future. So fixed payments are basically your rental payments. So let's say you are paying $1,000 per month over the next 4 years, which means these are 48 months. So you're basically saying 1,000 times 48. But we already know by now that the amounts of money you're going to be paying in future are not worth the same as the amount of money you would have paid today. Which means whatever amounts you're going to pay in future needs to be discounted to present value terms. So this is a concept you will have perhaps done in management accounting. So we are looking at 1,000 times 48, but in present value terms. Then we will consider what are the amounts that are expected to be paid under residual value guarantees. So maybe within the contract you have agreed that at the end of the 4 years, I'm going to pay you $5,000. This $5,000 is going to be perhaps just the purchase price of the asset in the condition it will be at the end of the lease. So maybe you are guaranteeing that you pay $5,000 at the end of the lease. Then options to purchase that are reasonably certain to be exercised. So you're saying, at the end of the 4 years, I'm going to purchase this building from you. I'm almost 99% certain that I would want to actually buy that building. If this is certain, then whatever amount you are going to be paying there should be included. Then are there any termination penalties if the lease term reflects expectations that they will be incurred? So these two then becomes opposites. Either you are sure that you are actually going to purchase the asset at the end of the lease, or we are now almost sure that we are not going to be buying that asset. In fact, we are going to terminate the lease before the end of the 4 years, which means you can't have these two figures at the same time. You either have this or you have that. All right, so that's your lease liability. So one key issue to remember is if there are payments that are made at or before commencement, it means at the initial recognition, these amounts should then not be included in lease liability, because remember, lease liability means the amount of money you are going to pay. So let's say we have calculated the present value of all the payments you are going to make in future and said the present value is 12,000. It means you have 12,000 there and you have 12,000 there. So let's say all these other things are not there, but there's a requirement for you to pay 3,000 deposit. It then means the right of use asset there would be 15,000. But that 3,000 can't be there because it's an amount that you have already paid, which means it's not an obligation, it's not a liability, which means you have a right of use asset of 12,000. Sorry, you have a right of use asset of 15,000 and a lease liability of 20,000, which means the amounts would be different. But this can only happen if you have actually made payment at or before commencement of the lease. So I hope this part is clear. Right, then subsequently, the lease liability is increased by the interest charge, which is also then recorded in the statement of profit and loss. So let's not worry about this for now. Let's do a question, and then I will illustrate how this works. So let me draw my table here and say here, there. And then this is opening balance, take note. And then this is interest. And this is installment. And this is closing balance. So what we are saying here is, at the inception of the lease, we are going to consider all the payments we are going to be making in future. From the payments we are going to be making in future, we are going to discount them back to present values, which means 1,000 in a year's time, we discount it to now. 1,000 at the end of the second year, we discount it to now 80, and then we come up with an amount. That's the amount that we are going to put now. So let's say Capital Company enters into a 5-year lease on 1 January 2024, an asset whose remaining useful life was also 5 years. The lease provided for 5 annual payments in arrears. And the interest rate implicit in the lease is 5%. At the inception of the lease, the present value of all lease payments was 400,000. What are the amounts to be recognized in the financial statements at 31 December 2023 in respect of this transaction? Okay. Right. So we have our year one, and we are told that at that particular date, the present value of all payments was 400,000. But we are then told that the interest is 5%. So 5% of 400 gives us 20, which means at the end of the year, since the lease payments are paid in arrears, it means at the beginning of the year, the total amounts we needed to pay in present value terms were worth 400. But the interest we are being charged is 5%, which means at the end of the year, we'll then have 400 at the beginning of the year plus 20 interest to make it 420. Then we will consider how much are we actually paying per year. So we are paying 90,000 per annum. So it means at the end of the first year, we had 400 at the beginning, we added interest of 20 to make it 420. We subtract 90 that we are going to be paying at the end of the year to get 330. So this is what's happening at the end of the year, which is 2022. All right. Then we consider at the beginning of 2023. At the beginning of 2023, the amount that we owed was 330. The interest is still 5% of that amount that we owed, which then gives us 16.5. We are still paying 90 each year, which means the balance that remains at the end of the year becomes 256. Now, our question there, what are the amounts to be recognized in the financial statement? This is actually at the end of 2022. Sorry about that. Right, so this is the accounting treatment at the end of the first year. Right, we are saying this is the interest that we are actually paying. The owner of the building is not going to give us installments such that we are going to be paying 400,000, because 400,000 is at today's values in present value terms. Is obviously going to put interest to compensate for things like inflation, opportunity cost, risk of default, etc. Which means it's going to require more, which is the 5%. That's where the 5% comes in. So it means this 20 there should then go to profit and loss. So this is the interest expense for the first year, or for the year to 31 December 22, since this lease we entered it on 1 January 2022. So we are going to recognize interest expense or finance cost of 20. All right. Then in the statement of financial position, we are saying 400,000 is the present value at inception, which means 400 also then becomes the value of your right of use asset. So your right of use asset at inception is 400. We are told that the useful life is 5 years. So we are then basically going to say 400 divided by 5, you get your 80,000. So 80 then becomes, so for simplicity, since we have been removing zeros, let's remove this. So we are basically saying your depreciation charge is 80 for the year to the 31 December 2022. So we have taken into account our depreciation, we have taken into account our interest expense of 20. Right? So it means our right of use asset in the statement of financial position then becomes 400 minus 80, which means we are going to report a right of use asset of 320. So that's in our statement of financial position. But remember, we also have our lease liability. So in terms of lease liability, just like any other long-term liability, be it a long-term loan, we need to separate between the current portion and the non-current portion. Right. So we know that at the end of 2022, 330 is the amount that we owe. So 330 is the lease liability at the end of 2022. But a portion of this 330 is actually due at the end of 2023, which means in a year's time. So if an amount is due in a year's time, it means it's a current liability. So it's easy to calculate because we know that at the end of 2023, it will now be 256, but now it's 330. So how much would we have paid so that at the end of 2023, the figure remains 256? It's basically the difference between the two, which means on lease liability, we know that it is 330 in total, but 330 is divided into two. Firstly, we have a non-current liability, which is 256. We know this because that is the value at the end of 2023, which means it's the money we need to pay beyond 2023, which means beyond 1 year. Then what then becomes current is the difference between the two. So that becomes 73.5. Right, so this 256 or it's 256.5, that's why this is 0.5. If it is just 256, it means this, because this becomes so let's simplify this. Let's remove that and let's remove that, and then just calculate it directly and say 74 here. We have simply said 330 minus 256. So this is the current portion. This is the non-current portion, such that the total of the two becomes 330, which is the amount that is owing at the end of 2022. So, one, we have our depreciation that goes to profit and loss. Two, we have our interest expense that goes to statement of profit and loss. Three, we have our right of use asset that goes to the statement of financial position. Then we have our current and non-current portions of the lease liability that also goes to the statement of profit and loss, the statement of financial position, sorry. So that's basically how we do a calculation for a lease. Right, so let's do one more question and then we'll be done with the standard. So ABC Limited owned a building on which it raised finance. ABC Limited sold the building for 6 million, its fair value to the finance company on 1 June. Sorry, just a moment there so that we can see. Okay, so in the finance company on 1 June 2021, when the carrying amount was 3.6 million, the same building was leased back from the finance company for a period of 20 years. The remaining useful life of the building is 25 years. The lease rentals for the period are 441,000 payable annually in arrears. The interest rate implicit in the lease is 7%. The present value of the lease payments is 5 million. The transaction constitutes a sale in accordance to IFRS 15. Advise ABC Limited on how to account for the above transactions for the year ended 31 May 2022. Okay, so we have here ABC Limited, who owns a building, right? Then ABC Limited then approached a finance company, right? So this finance company did not own the building before, right? So we wanted to raise finance. We are ABC Limited. We want to raise money, but we don't have any other means besides selling the building that we are occupying, right? But we wanted to continue to use this same building even after we've sold it. So we approach a bank and say, we wanted to sell you this building, but after selling you the building, we want you to then give us a lease agreement because we want you to continue to occupy this building. So this appears like there are two transactions here involved. We own the building, but we sell it. So we are going to sell this building, right? Then we sold the building for 6 million. So we are saying perhaps we received this 6 million after selling the building. Then after selling the building, we then go to the company that bought the building and say, we want to continue using this building. So we want you to give us a lease. We are going to pay you 441,000 per annum for the next 20 years. Okay. So what is happening here effectively is we have simply gone to the bank and borrowed 6 million. Because this money was given to us by the bank after we had sold the building. But then we now owe the bank 6 million effectively. And we are going to be paying it back by paying them 441,000, sorry, per annum. And the interest rate implicit in the lease is 7%. Which means we are basically just paying the 6 million back to the bank at an interest of 7%. So that's effectively what the transaction is all about. We've sold the building to the bank is leasing back the building to us. And so the sales itself qualifies as a sale according to IFRS 15. But then the lease is a separate transaction. But because we can see what happened here, basically we went and borrowed the money and used the building as security effectively and continued to then occupy that particular building, right? So we want to see the accounting transactions that we need to then do to take care of this transaction. All right, so this effectively is a lease, right? So since it is a lease, there is right of use assets and there is lease liability. Now we are told that the present value of the lease payments is 5 million, which means the 441,000 we are paying every year for the next 20 years. If we were to calculate its present value, we would actually get 5 million, which means we've got a right of use asset of 5 million. We have a lease liability of 5 million. Now, this becomes as it seems from a right of use perspective, we are simply going to say 5 million divided by the 20 years for us to get the depreciation charge. Right, so our depreciation charge then becomes your 5 million divided by the 20 years, which gives us 250K per month, per annum, sorry. So it means in our statement of profit and loss, we are going to recognize depreciation of 250,000 per annum. So it means the value of our assets in the statement of financial position, which is our non-current asset, will then be your 5 million, I've removed 3 zeros, minus 250, I've also removed 3 zeros, then becomes 4,750. So this is statement of profit and loss, 250,000 depreciation. This is statement of financial position, the carrying amount of the right of use asset, which is 4,750. So that's as far as the right of use asset is concerned. Right. Then before we even go to lease liability, let's also consider a separate transaction that happened. We had a building that we sold for 6 million. So the proceeds from selling this building was 6 million. So let's just remove 3 zeros and remain with 6,000 there. The carrying amount was 3.6 million. So the carrying amount of this building was 3,600. So we had the building with the 6,000. that we sold for 3,600. So if we say 6,000 minus 3,600, we'll get 2,400. So we have actually made a profit on disposal of this building of 2,400. But we have not earned all of this profit because we have said this transaction looks like we've simply borrowed 6 million, used our building as security. So if you fail to make any payments, the bank can simply withdraw the 6 million and say, give us all the money now, or we are taking over the building because it belongs to us and we put someone else. Which means we have not actually earned all of the 2,400 now. Rather, we are going to be earning the 2,400 over the lease period, which is 20 years. Which means we are then going to say 2,400 divided by 20, we get 120. So each year, we are going to recognize a profit or other income of 120. So this is how it works. This year, which is, this happened 1 June 2021, and our year end is 31 May 2022, which means at the end of the first year, our profit on disposal that goes to profit and loss is 120. It means what remains is 2,400 minus 120. So if we say 2,400 minus 120, what we get is 2,280. Right, but wait a minute. The 2,280 is income that we have not yet earned a right to. So we call that deferred income. Deferred income is a liability. What we need to then consider, like any other long-term liability, is which portion is current and which portion is not. So 120 of this is going to be earned by the end of the following year, which means it becomes a current liability. So if we then remove the 120, we remain with 2,160. This then becomes the non-current liability. So in other words, we made a profit on disposal of 2.4, which is this one. At the end of the current year, we would have earned the 120. So we're going to recognize it as other income, which means what remains unearned is 2,208. Of the 2,208, 120 is going to be earned by 31 May 2023, which makes it current because it's within 1 year. And 2,160 of it will be earned in years beyond 12 months, which means this becomes the current portion, this becomes the non-current portion, the total of which is 2,280, which we have not yet earned. So from a right of use asset, we have depreciation 250, statement of profit and loss. We have profit on disposal 120, statement of profit and loss. We have 4,750 non-current assets that goes to statement of financial position. We have 120, the current portion of the deferred revenue that goes to current liabilities in the statement of financial position. We have 2,160, which is the non-current portion of the deferred revenue, which goes to statement of financial position. So that's what we need to know from a right of use asset perspective. Right. Now let's consider the deferred, the lease liability component of our lease transaction. All right, so we have said the lease liability means these are amounts that we are going to be paying in future. But since we are going to be paying them in future, they are going to earn interest. The interest rate is the interest rate that is implicit in the lease. If you are not given an interest rate implicit in the lease, it means the examiner wants you to use the borrowing rate. But in this instance, we are given. So we are going to say your year, your opening balance, your interest, your installment, and then your closing balance. So at the beginning of year one, right? So we are saying beginning of year one, our year one is 22, May 22. Right, at the beginning of the year, which was 1 June 2021, the present value was 5 million. So we remove 3 zeros and just put 5,000 there. The interest is 7%, which means we are going to say 7% multiplied by 5,000. And then we are going to get 350, which means what we owed by then was 5,350. We are told that we are going to be making payments of 441. So it then means we are going to say 5,000 plus 350 interest that is accrued minus 441 that we have already paid. It then gives us 4,909, which means at the end of the second year, which is 2023, we started off with 4,909. Then we calculate the interest at 7%. Let's round it off to 344. Okay. We are still going to be paying 441 there. So we then say 4,909 plus 344 minus the 441 we have paid, we get 4,812. Then immediately, because we know that we are going to require a current and non-current portion, we are then going to say 4,909 minus 4,812, we get 97. So it means in our statement of profit and loss, we are going to consider 350 as your finance cost. So this is the interest. So it's a finance cost. It goes to the statement of profit and loss for the year ended May 2022. That's one. Two, in our statement of financial position, we know that the total amount that we owe at the end of May 2022 is 4,909. Of the 4,909, we know that by the end of the following year, which is May 2023, we would be left with 4,812. So the 4,812 is the non-current portion. But for us to get it there from the amount we owe now, we would have paid 97, which means 97 is the current liability portion, the amount we are going to pay by the end of May 2023, such that what then remains becomes 4,812, which is your non-current liability. So that's basically how we determine lease liability transactions. Right, so I hope that was clear. That's as far as leases are concerned, and that's what we are required to know. All right, so that's all we need to discuss as far as the standard is concerned. Thank you.